Good evening and welcome back. In our last few updates, we've been tracking NIO's steady climb toward the $5 level, watching as the stock edged closer and closer to what we called a make-or-break psychological and technical barrier. On Monday, we closed at $4.91, just shy of that mark. The setup was there. Support around $4.80 was holding, sector sentiment was relatively constructive, and the battery swap profitability story, along with the upcoming ONVO L90, was giving us a fundamental backbone for the bullish case. But Tuesday reminded us that in the stock market, especially with Chinese EV names, nothing moves in a straight line. Instead of pushing through $5, NIO pulled back hard, dropping sharply intraday and closing well off Monday's highs. So what happened? Let's unpack Tuesday's action, look at what drove the reversal, and see whether our broader narrative still stands or needs adjusting. First, the numbers. On Tuesday, NIO opened under pressure, and selling accelerated through the session. That hope of an early push toward $4.95 or above never materialized. Instead, sellers stepped in aggressively, knocking the stock back toward the lower end of the recent range. This wasn't just a minor fade, it was the kind of session that forces traders to reassess the short-term technical picture. And while it's tempting to pin this entirely on technical resistance at $5, there was more going on under the surface. Three main factors stood out. The first was the return of the EV price war in China, sparked by none other than BYD. Reports surfaced that BYD had cut prices on 22 different models. These weren't token discounts, they were meaningful reductions aimed at defending or growing market share in a hyper-competitive domestic market. That kind of aggressive pricing ripples through the sector. For NIO, which positions itself as a premium brand, price wars are tricky. On one hand, you don't want to cheapen the brand by chasing competitors down the pricing ladder. On the other, you can't completely ignore shifts in consumer expectations when rivals are suddenly more affordable. Investors know that if price wars persist, margins across the sector can get squeezed. That was a cloud hanging over the whole EV group on Tuesday, and NIO wasn't immune. The second factor was a renewed flare-up of delisting fears. The US-China regulatory relationship is never far from investors' minds when it comes to Chinese ADRs. This week, there's been renewed political noise around audit compliance and market access. Even without a concrete policy change, just a reminder that delisting risk exists is often enough to spook some holders and trim positions. And with sentiment already fragile in the space, that was another weight on NIO's shoulders during Tuesday's session. The third factor was sector-wide weakness. Even before NIO's drop accelerated, we saw other Chinese EV names trading in the red. XPeng and Li Auto were both off their highs, and the broader Chinese market didn't have a strong lead-in. Without a rising tide to lift the group, it's harder for any single name to push through major resistance levels on its own. So, combine a price war headline, regulatory overhang, and a weak sector tape, and it's not hard to see why Tuesday didn't give us the $5 breakout we were hoping for. Now, the question is, does this derail the broader bullish case we've been building over the past couple of videos? In my view, not entirely, but it does change the short-term roadmap. Let's talk about the technical picture first. Support at $4.80 has been key, and after Tuesday's drop, it's back in focus. If we can hold above that level and avoid a close below it, the structure remains intact. But a decisive break under $4.80 could open the door to a deeper retracement, possibly toward the mid-$4.60s. That's not catastrophic in the bigger picture, but it would push out the timing of any $5 retest. For the bullish thesis to stay alive in the near term, we'll need to see evidence that Tuesday's selling was more of a reaction to external headlines than a wholesale rejection of NIO's story. And that brings us back to the fundamentals. The battery swap economics we've been talking about remain unchanged. The company has surpassed 80 million cumulative swaps and is averaging roughly 97,000 swaps per day, about one every 0.88 seconds. Those usage rates mean many stations, especially in urban hubs like Shanghai, are now at or above break-even, transforming what used to be a heavy cost center into a cash-generating infrastructure asset. That's a long-term advantage that doesn't disappear because BYD cuts prices on a few models. In fact, the more competitive the EV space becomes on sticker price, the more valuable it is to have a unique service offering that keeps customers loyal and differentiates the brand. And then there's the ONVO L90. CEO William Li's target for a Q4 2025 profitability lift from this new model still stands. This is a strategic expansion into a broader market segment without abandoning the technology and infrastructure that make NIO distinctive. If successful, it could add meaningful volume while keeping swap station utilization high, further enhancing the economics of the network. Of course, none of this guarantees smooth sailing in the share price. The short-term market still has to digest Tuesday's headlines, and traders will be watching closely to see if buyers step back in or if the selling continues. But from a fundamental perspective, the pieces we've been highlighting, profitable infrastructure, strategic product expansion, and a growing ecosystem moat, remain in place. The challenge now is more about market psychology. Breaking through $5 requires not just solid fundamentals but also the right sentiment environment. Tuesday showed that sentiment can shift quickly when external factors intrude. Price wars, delisting chatter, and sector softness are all sentiment killers, even if they don't materially change NIO's internal trajectory. So, how do we frame the days ahead? For traders, the near-term focus is on $4.80. Hold it, and the $5 breakout story is delayed but still viable. Lose it decisively, and we might need to recalibrate expectations for a rebound before retesting the highs. For investors, the focus should be on whether the fundamentals we've discussed continue to strengthen. Watch the swap numbers. Watch for updates on the L90 rollout. And keep an eye on how NIO responds strategically to pricing pressure in the domestic market. If you've been following along, you know my tone on NIO has been measured but leaning bullish. Tuesday doesn't flip that stance, but it's a reminder that this is still a volatile stock in a volatile sector. Position sizing and patience matter. In the bigger picture, the $5 level is still an important marker, but it's not the finish line, it's just the next checkpoint. What matters more is whether NIO can navigate the current competitive and regulatory environment while continuing to execute on its infrastructure and product strategy. If they can, the stock will have multiple opportunities to retest and eventually clear $5, even if Tuesday wasn't the day. So, to wrap up, Tuesday's pullback was a disappointment for those of us looking for that breakout confirmation, but it wasn't a death blow to the bullish case. It was a reminder that in this market, you have to keep one eye on the fundamentals and the other on the macro and sector currents that can shift sentiment in an instant. We'll keep tracking all of it here, so if you want to stay up to date on both the chart action and the bigger strategic picture for NIO, make sure you're subscribed. And let me know in the comments, was Tuesday just a bump in the road, or do you think this signals a deeper pullback before we get another shot at $5?